Let's now bring in James. Good morning.
Hi, James. Great to be with you.
Thank you for doing this again. It is a little while since the last time, but it's a good, interesting trust, I think, abrdn New Dawn. So it's good to get to catch up on it. I think, as usual, we get you to just explain a bit what the fund's doing, please, first, and then we'll sort of dive into some questions.
Yeah, delighted to. So let me just take 10 or 15 minutes just giving you that overview and update. So just to recap, abrdn New Dawn is an Asia Pacific ex-Japan investment trust. So it's investing across the stock markets in Asia, including Australia and New Zealand, also as a sort of bit of a differentiator, I guess, versus some of the other investment trusts that you find in the peer group. It's managed to a long-term quality investment process, so it's neither growth nor value. So the emphasis is very much on quality stocks, quality businesses, and we are building the portfolio from the bottom up rather than top down. So selecting stocks based on our first-hand research, which is really the cornerstone of our investment process. And I have the good fortune to be able to draw on a very large team located across Asia. We have several offices. I'm based in Singapore, which is the headquarters for abrdn in Asia, but I have colleagues in Hong Kong, in Shanghai, in Kuala Lumpur in Malaysia, in Thailand. So a large team, and that's a great kind of research engine for both keeping on top of what the companies in the portfolio are doing, but also, of course, generating new ideas and identifying new high quality names for the portfolio. We have what do we mean by quality? I mean, everyone defines it slightly differently. We're looking at the sort of quantitative metrics that you'd expect us to be looking at. So sort of stable, predictable growth and cash generation, superior margins and profitability and return on equity and capital. Quite a big focus on balance sheet strength. We are long-term buy and hold investors, so we want companies that can sort of sustain themselves through the cycle and the tough times like those that we find ourselves in currently. But also just very clear articulation of what the sort of competitive advantage is and their ability to sort of sustain their often market-leading positions in their respective industries. But ESG is a sort of core quality criteria for us as well. So we're looking at all aspects of that, and it's incorporated into the investment process. And engagement with the companies that we are shareholders in is a key part of the process too. So all of this together leads to a kind of high conviction, active portfolio of high quality names, which, as I say, we hold for the long term, and that's delivered a pretty decent long-term track record in terms of performance. It gives you some respectable upside participation, but also protects you on the downside as well, given the quality characteristics. So I think this is more just for sort of disclosure terms. I won't dwell on it. I think we can just move straight on to the next slide, where I've given you some of the sort of key characteristics of the trust. As you would expect of a high quality portfolio that I've just described, this portfolio has a higher return on equity than the broader Asian universe, so almost 20% ROE. It's got a very robust balance sheets in aggregate, so that net debt to equity ratio towards the sort of on the right hand table is net cash overall. It gives you, given our sort of quality focus, it gives you a mix of income. I mean, we're not targeting income, but it does have an underlying dividend yield of 2.2% on the portfolio, coupled with growth as well. So you can see the historic 3-year EPS growth is 12%, and bearing in mind that's been through the pandemic years. It has a large cap bias. It is buy and hold, so you see low turnover there, about 20%. And given the closed-end nature of the trust, obviously we have the luxury of being able to use some gearing, which we do so conservatively, and it's about 8.5% geared currently. So that's a kind of quick overview of the trust. I'll come to how we're positioned shortly, but maybe just before I do that, some quick thoughts on the kind of macro picture. And I've given kind of 4 things to be thinking about here. Obviously, the sort of bigger global macro backdrop is key. So we're sort of, feels like to me that we're kind of flip-flopping between whether the US in particular and maybe the West more broadly is going to have a hard landing or a soft landing, and it seems to sort of change every month, with maybe at the moment a soft landing looking a little bit more likely, but clearly, you know, should the West go into recession, and I think our sort of house view is that a recession is still likely, then Asia is not going to be immune or unaffected by that, given particularly for the sort of large export engines and sectors. This also has implications for the US dollar, of course, and a strong US dollar tends to be bad for Asian markets. So if we would continue to see strength in the US dollar, that will be a headwind. But if we see rates sort of peaking and tapering off and that sort of reducing the strength in the US dollar, then that could be positive for Asian currencies and for sort of capital flows into Asia. And then I think the other kind of key thing that we've been thinking about here has been the state of the US and European financial sector. Obviously, we've had the collapse in Silicon Valley Bank and First Republic and Credit Suisse merging with UBS, and have been thinking about what that means for Asia and whether there's going to be more to come. I think, you know, looking at the banking system in Asia, we feel quite comfortable and confident that they're certainly insulated from sort of direct contagion. But we are sort of cognizant that this kind of risk aversion could lead to a sort of tightening up of liquidity and slowing down a growth as banks look to sort of conserve capital. But overall, Asia's banks are in pretty good health from a sort of balance sheet perspective, so less exposed to the sorts of issues we've seen in the West. And I would say more broadly, from a macro perspective, Asia feels like it's in a better place. Certainly, inflation is much more benign out here. That's meant that the rate cycle has been much less aggressive, which has been better for growth, and we are still seeing growth in this part of the world, and recession seems highly unlikely. So I think, you know, as we move to a world where monetary policy will normalize, I'm hopeful that will lead to markets focusing more and more on fundamentals, and fundamentally Asia stacks up relatively better, I feel. On China, a sort of mixed picture, and I can, you know, happy to sort of talk more on this maybe in the Q&A. I've just returned from China. I was there last week. So getting a sort of first-hand perspective. There was obviously lots of excitement about the reopening at the end of last year, and that has not played out as expected. The sort of pace of the recovery has been below expectations, and certainly consumption feels quite soft still. So a kind of mixed view there. I think from a market perspective, that has weighed on the Chinese equity market, and my sense is that there's a fair bit of value emerging within the market. So there are opportunities there that we're seeing, and obviously geopolitics kind of looms large still, particularly between the US and China. So that's been a continued kind of issue that we've had to navigate quite carefully within the portfolio. In contrast, India, I think, in a very different position. It feels like the kind of stars are aligning for India. We've liked it for a long time now. From a bottom-up perspective, we think it's home to some fantastic quality companies, and that's why we've had a sizable exposure to India for many years now in New Dawn. But that's now sort of coming together with a quite compelling and attractive top-down macro story, where you have growth feeling like it's about to accelerate with India at the sort of early stages of a cyclical recovery, and that's fueled by a new credit cycle, significant spending in infrastructure, supported by government spending and policy, a recovery in a long overdue recovery, frankly, in the residential property market, and a new sort of capex cycle. So quite a bit going on in India, and I was there earlier in the year, so happy to sort of expand on that as well. And then just briefly on the micro trends, I think, yes, clearly it's a tough year. Growth has slowed, as it has all over the world, in Asia too. But we do still see growth coming through. And from a sort of corporate fundamental standpoint, balance sheets for the most part are strong. So you look at sort of net debt to equity ratios, as you saw for the portfolio, but even for the market, pretty healthy, certainly compared to many other parts of the world. Earnings growth sort of set to come back as we go into next year. I think the first half has been tough. Second half should be a bit better, depending on what happens in the West. And a lot of the sort of bad news, I feel, is priced in as well, with valuations trading kind of below their sort of long-term averages. So that's on some sort of things to be thinking about from a macro standpoint. Let me move now to the positioning of the trust. So on the right, you've got the top 10 holdings, and on the left, you've got positioning by country and sector. I've given it, this is relative positioning, which may or may not be helpful. I mean, I think it shows you that it is a very much actively positioned portfolio, as I said. So a high conviction portfolio built from the bottom up, so quite different to the Asian benchmark. If you want to see the absolute positions, those are available on the monthly fact sheet, which is on the website. But just to give you a sort of few highlights here, we have, in absolute terms, about a quarter of the portfolio in China currently, which is below the MSCI Asia Pacific ex Japan, which is the benchmark that the trust is assessed against. So underweight China, but in absolute terms, quite a meaningful position. And you can see that we have an overweight to Hong Kong. So in absolute terms, that's about 10 to 11% of the portfolio. So I guess if you put Hong Kong and China together, it's about 35, 36% of the portfolio. So reasonable weighting still in China. And that's across a variety of different sectors. And as I say, there is plenty of macro issues to be thinking about, but from a stock standpoint, still some great companies and quite a bit of value emerging there. India is a meaningful position. It's about 16% of the portfolio overall, and a larger weighting relative to the benchmark. As I said, we've liked it for a long time from a bottom-up standpoint, and that's now coincided with this favorable kind of macro backdrop. Southeast Asia is quite a meaningful weight or position in the portfolio as well. Indonesia, you can see here, is a meaningful overweight. We've got several companies there, but also across kind of Singapore, Philippines, even Vietnam. So that's a sort of differentiated position, I think, versus some of the peer funds that you see. In contrast, very little although we have the mandate to invest in Australia, you can see that relative to the benchmark, we have relatively little there. And Taiwan, we just have one stock, which is Taiwan Semiconductor, which you can see is the largest single stock in the portfolio at about 8%. We get our exposure to India via the fund rather than directly, and I can kind of explain that if needs be. And then on the top 10, just briefly, in addition to Taiwan Semiconductor, we've got a few holdings in the tech space. So Samsung Electronics at number 5 there, and ASML, which is actually a Dutch business that you may know, but it derives more than 3/4 of its revenues from Asia. So we, on that grounds, think it deserves a place or merits a place in New Dawn. And then AIA, which is one of our Hong Kong listed stocks, but really a sort of proxy for the region and China. Same would be true of Budweiser Brewing as well. I'd be happy to talk on any of these stocks. But in the interest of time, let me just move to my final slide, which is just the performance for you. So, as it has been for markets globally, it's been a tough start to the year in Asia as well. So in absolute terms, the NAV is down, and you can see over 3 months down 10.5%, over 1 year now down about 7%, though still positive on a sort of annualized basis for 3 and 5 years. And relative to the broader Asia market, we're trailing slightly for the start of this year, which is weighing on the 1 year performance as well, although we're still outperforming on a relative basis over 3 and 5 years. And that's a lot to do with stock selection in China. It has been a volatile market, frankly, with all the exuberance around that reopening and now that sort of unwinding in more recent months. So it's just been a tricky market to navigate. In contrast, I think we've seen some really good performance in our India holding, in Indonesia, and in our tech holdings as well. So that's where we are on performance. And again, I'm happy to talk more on that. So let me finish there, and happy to answer any questions.
Sure. Okay. Sort of big picture macro stuff first, I think. So the first question actually that popped up was, how do you actually manage geopolitical risk? I mean, the questions are about China, Taiwan, and Hong Kong, stuff like that. But I suppose it applies across the whole region. Is it something that you can manage or would do anything about?
Yeah. So I think as I said, we are a bottom-up manager. So we're first and foremost selecting stocks from the bottom up, looking at the individual companies, their fundamentals, and making sure that they meet our quality criteria. So that's the sort of stock selection process. But then when you think about portfolio construction, inevitably you have to think about some of these macro risks and geopolitics, and just try and be sensible about how you're positioning. I would say, TSMC in Taiwan is potentially, being a Taiwanese listed stock, in the crosshairs of the sort of geopolitical tensions between China and Taiwan, and we are cognizant of that, and we have thought about that at the stock level. And in TSMC's case, we've sort of taken the view that I mean, too big to fail is not quite the right way to put it, but sort of is how we think about it, on the grounds that the entire world needs the semiconductor chips that TSMC produces, and there is very little alternative. They have a near monopoly in the sort of super high-end chips. So, China needs it, the US needs it. So it would be a very bad outcome if that company were to be sort of taken over, and even if it were, it would still have to be kept running, whether by the Chinese or by the Taiwanese, whatever. So we feel like that stock's somewhat insulated from the geopolitics in that respect. Although, if we were to see an invasion of Taiwan, which is not what we think is going to happen, then frankly, there's probably bigger things to worry about. Similarly, in China, we think about the US China tensions there, and again at the stock level, have done our best to either not invest in companies that have geopolitical exposure, so just avoid it completely. And we have within our China position, we have quite a big exposure to domestic Chinese kind of consumption names that really are not impacted by this, or where there is some geopolitical exposure. For example, maybe it's a Chinese company that's exporting to the West, then we understand that in full. We understand what the strategy is and options are for dealing with that, and what the impact to the P&L could be, and whether that's sort of that risk is sufficiently priced into to the share price.
Okay, thank you. The sort of political interference within China with some of the companies that we saw a few years ago, things like Alibaba and Tencent. Do you think that's gone away now? I know that the one guy sort of disappeared for a bit, and they turned out that he's been sort of held by the corruption police or something. I mean, Is that fading away now, or do you think there's going to be more of that?
Yeah, so I think there's a couple of different things there. So there's the anti-corruption drive, and that hasn't gone away. That is still happening in China. Less relevant for the internet names. I think that the sort of spotlight has shifted and moved now. That we're seeing quite a bit of activity in the financial services sector in China on the sort of anti-graft, anti-corruption sort of agenda. So I think periodically we're going to have these kind of disappearances or, kind of arrests or whatever, as China continues to try and sort of clean itself up. And then there's the sort of broader regulatory piece. And there, I think, I think the worst is over for the China internet sector. It's not going away, so we're not going to see a rolling back of regulation at all, and there'll be sort of incrementally more to come, but not of the sort of scale and disruptive nature that we have seen over the last several years. So, and there've been kind of announcements by the central government to that effect, to say that it's sort of basically done for now. So I think the outlook for, specifically, you can see with Tencent here is a large holding for us still. We're pretty constructive on the outlook. We think for Tencent, one of the issues they were grappling with was a lack of approvals for new game titles in their gaming business. That now has been removed, and they've got a very good pipeline of games that are getting approvals through. So I think the outlook is much improved.
Okay, thank you. The China underweight, is that like a long-term thing? I know the Indian overweight is a long-term thing. Is the China underweight something that's persisted for a long time?
So yes, but it has evolved. So I think if you went back, let's go back 10 years, and if you were to sort of pull out the fact sheet, then I think we would have had about 5 or 6% of the portfolio in China versus the kind of 25 or so percent we've got now. And we were using at that time Hong Kong as a sort of bigger proxy for China, so preferring to play China indirectly. Today, so we're still underweight, obviously, but that underweight has narrowed quite significantly over the years, and that really just is a function of us being able to get more comfortable with the underlying quality of the companies in China. And one of the big enablers there for us was sort of five or so years ago when Aberdeen launched its China A-share fund, and all the work and sort of due diligence that went into that launch and to analyzing companies within the A-share market really opened up that as a new market for us. And so now New Dawn has benefited from that substantially and has quite a large number of domestically listed A-share stocks in the portfolio, thanks to that.
Okay. Few questions here about sort of the rest of Asia. So I suppose India and China grab all the attention, but so have you got sort of favoured markets within the rest of Asia?
I guess India, as I've said, the kind of macro outlook there is probably better than anywhere else in the region at the moment. And obviously it's a very large market, huge 1.4 billion population, rising wealth levels, and that's just fueling this kind of structural growth in the country, irrespective of the economic cycle. So definitely India. Beyond India, I think Southeast Asia, from a sort of top-down standpoint, is still a pretty interesting and quite attractive market. The challenge is finding sufficiently good quality and liquid enough companies to invest in some of these Southeast Asian markets. And so New Dawn, again, having the benefit of that kind of closed-end structure, can take a bit of an all-cap approach. And whilst we do have a bias to large cap companies in the portfolio, there are a handful of small cap, less liquid names, and many of those are in Southeast Asia. So markets like Vietnam, we've got a couple of stocks there. Indonesia, we've got a couple of large cap stocks, but also a couple of small cap stocks. So and valuations, I think, in Southeast Asia remain pretty attractive because it's just been a region that's been so out of favor for so long now.
Yeah, exactly. What is the sort of liquidity requirement? What's the sort of cutoff for something that you look at?
I mean, no hard rule. So I guess a rule of thumb, rough rule of thumb might be, $1 billion sort of market cap. But obviously Asian companies often have a single large dominant shareholder that may own the majority of the shares, and therefore what's more relevant is the free float and sort of liquidity within that. So we look at the kind of liquidity on the free float and how much of the free float we own or would own. So but very, very unusual to go below $1 billion.
Okay, fair enough. Now you talked about you've got colleagues in different markets around Asia. Are they effectively sort of the go-to person for stocks in those countries, or is it still run on a kind of pan-Asia basis?
So where we have a presence down on the ground, yes, they will be the go-to for kind of for research. So every stock in the portfolio has an assigned stock owner, and so in China, to use that example, I have a large team of colleagues spread across Hong Kong and Shanghai, and between them they are responsible for each and every China stock. So if I have a query, then they'd be the first port of call. They also help with the kind of idea generation. So yes, it's kind of built and from that kind of research engine.
Okay, that makes sense. Okay. One of the things that we've sort of read a lot about is the sort of China plus one idea that people aren't just putting new manufacturing plants in China, they're actually moving them to other countries, or sometimes they're just having something in China and something somewhere else. Is that actually affecting the Chinese economy at all, is the first question. And the other one is, who are the big beneficiaries of that policy?
So on the first part, on the margin it might be, but I think if you look at the kind of issues that are impacting China at the moment, it's much more about kind of domestic consumption, the weakness in the property market. Yes, industrial kind of manufacturing activity is down a bit, but the bulk of the issues are on the sort of consumption side. FDI is still happening in China. I was there last week at the same time as Elon Musk was, trying to get his Shanghai giga factory up and running and approvals in place. That's an example of a high-profile business that's still investing substantial capital into China and driving job creation and so on. And there are many, many other examples. You saw that we have Budweiser Asia Pacific in the portfolio as a top 10 holding. That's a multinational business. The arm we own is the listed Asian arm, but it's a multinational business, and they're still super bullish on the China opportunity in the China market. So I don't see it as a major issue. I think what's happening is it just a realization as a result of the pandemic, and also, of course, with an eye on the geopolitics, that that you have to be diversified in your supply chain. So in addition to China, you need something else as a backup. And so it's less about reducing China perhaps and more about just finding another location. And to your second question, what are the or who are the beneficiaries of that? Vietnam, absolutely, and has been for a long time, I think. So a lot of manufacturing has been set up in Vietnam, and more is coming. India is trying to position itself for this. Had a bit of a false start initially, but now seems to have got its act together and has sort of revamped its policy framework for this. There's something called the Production Linked Incentive Scheme that Modi has announced and put into action, and he's seen significant success in particular in the smartphone sector, and now you have got, I think I'm right in saying every major supplier to Apple has a presence in India as well, and there's a big effort by Apple to ramp up the sort of supply chain and manufacturing capability in India, as an example, and they're trying to replicate that across other sectors as well with varying degrees of success so far. Bangladesh is another country that gets talked about as a beneficiary here, and Malaysia as well.
Bangladesh isn't the country that figures on this list. What's the sort of policy that you're investing in frontier markets?
So we are able to invest in frontier markets. So we've got a holding in Sri Lanka, for example, just one stock. Vietnam talked about already. Bangladesh, we could invest there, and there are a handful of companies that probably meet the quality criteria, but we've just not felt compelled to put them into the portfolio. But we have that flexibility.
Okay. What do you do with currencies? Do you hedge at all?
No, not at the portfolio level. In part, I think it's we're bottom-up stock pickers, so it's not our skill set, not our expertise, and currencies can so often be a sort of random walk and you get it wrong. So we don't hedge at the portfolio level. We do, of course, think about currency risk at the stock level. And we tend to see that in two places. One is on the balance sheet, so you do get companies that in Asia that, particularly in recent years, have been enticed by the low-cost US dollar loans, and so have taken on US dollar debt. We don't have, given our focus on balance sheet strength, and you saw it was a net cash portfolio overall. We don't really have that as an issue, but where there is, we're just satisfying ourselves that it's appropriately hedged and well managed, and there's a decent track record there. And then the other area has been on the sort of input cost side that impacts the P&L, cost of goods sold, and margins, and with the inflation that we've seen, coupled with kind of currency movements in the US dollar, that has been something that we've been very focused on. So that's I guess where we're sort of hedging the risk.
I mean, one question is about gearing. So first split that in two parts too. One is what drives the level of gearing, and the other is what currencies do you actually draw down the borrowing in?
So I think on gearing, we tend to be pretty conservative on it, and so rarely will we have more than 10% gearing on the portfolio, and I kind of think about having a sort of mid-single digit type gearing as almost kind of structural. I think investment trusts should have gearing on them. It's one of the benefits of the closed-end structure, and in for Asian markets, which over time you have to believe are going to continue to appreciate, then having some sort of structural gearing there, I think obviously enhances the overall return to shareholders. So I look at it as kind of 5-6% of structural gearing, and then the rest is just drawing down or paying down debt depending on what opportunities we're seeing. And typically in down where markets have sold off quite sharply and we're seeing value emerge there, but we don't want to kind of sell existing holdings that may have, also seen significant drops in share prices, then that is when we kind of draw on the debt facility to fund new purchases. And then at the opposite end, you paying down some of the debt when markets feeling a bit frothy and toppy, and we think valuations on individual stocks have got a bit out of hand. On currencies, we have majority. We've got two loans there. There's a sort of fixed loan which is in sterling, and then we have a multi-currency kind of revolver facility of similar size. And we have in the past drawn down on sort of US dollar, Hong Kong dollar. I think we have the option to do Singapore dollars if we want, and just sort of match it to the underlying portfolio as best we can.
Makes sense. Thank you. So I know it's a sort of long-term buy and hold strategy, but what have you been buying recently?
Yeah, and I can see there's a question here on typical turnover. So that was on the characteristic slide. So turnover is about 20%, more or less. So about a fifth of the portfolio churning each year. Much of that is kind of topping and tailing existing holdings, rather than necessarily initiating brand new stocks or exiting stocks entirely. In terms of what we've been doing recently with the portfolio. So we, as I kind of commented on earlier, I think there is value emerging in China. It's not straightforward given all of the headwinds that we've been talking about, but selectively we have been seeing value. So just adding a bit into China, into stocks that are either kind of defensively positioned. So, for example, we added to one of our healthcare holdings in China that has that kind of healthcare characteristics, nice defensive cash flows, and sort of insulated from a lot of the cyclical slowdown, or into companies that will benefit from the reopening. And there, it's been somewhat tentative because obviously that reopening is coming through, but just not anything like as fast as certainly the market was expecting it to come through. But there are companies that would fall into that camp. So, for example, AIA should see a pickup in insurance policy sales as travel between Hong Kong, which is its kind of home market, and China normalizes, and as its sales agents can sort of start traveling freely around China unencumbered by sort of COVID restrictions. Similarly, Budweiser Asia Pacific has its core channel in China. It has been the nightlife channel, so sort of bars and restaurants and things that were closed for so long and now are normal. The traffic's coming back and we're seeing a normalization of sales. So those sorts of opportunities where we think that the reopening will happen, that sort of pent up savings will get converted to spending, but it's just going to take a little while.
Okay. You've had all the Indian stuff held through the SICAR for a long time. Is there a point when you would invest directly in India?
Yes, there is. So just to explain why we have the India fund, it used to be some years back a tax efficient way of investing in the India market. So the India fund has a Mauritius structure that enables you to lower the capital gains taxes that's incurred when investing in India. That tax benefit has since disappeared pretty much now, so there's no longer that benefit. And I should just add that the India fund it's managed, actually I lead on the India fund personally, so it's managed by the same team, to the same investment process. There's no double charging of fees. So it's sort of entirely transparent and consistent with New Dawn. But increasingly, there's no longer a logic other than it gives you a diversified play on India to invest through the fund. So we are looking at going directly. As much as I love India, one of the frustrations is its bureaucracy, and so trying to set up a foreign portfolio investment account for New Dawn in India has proven quite a headache. So it's work in progress. Not there yet.
Fair enough. Yeah, that answers the questions about the challenges investing in India. And if there's anything else you'd mention there.
I think a little like China, you have to do your homework and you have to do your due diligence. It's one of those markets where it's very easy to lose your shirt still, and so there is no substitute for meeting the companies one-on-one, preferably in India on location. And to my point earlier about Asian companies often having a single large dominant shareholder, you have to know, and this is where the ESG and particularly the G piece comes in. You have to know who that shareholder is, what their kind of track record has been with regards to treatment of minority shareholders historically, and often it's a family, and they may be running the company as well as being the major shareholder. So drilling into kind of soft things like corporate culture and management style and these sorts of issues are really important, because as a long-term investor, we're making a call on ultimately whether we can trust New Dawn's capital with those individuals, those families, or those single large shareholders. So and that's particularly important for India. And just finally on this, listeners may have followed the story about the Adani short seller report that hit in the early part of this year, and caused a huge collapse so the Adani Group has 7 or so listed entities in India, and all of them sort of sold off very sharply on the back of this. And that's just an example. I mean, the short seller report had allegations of fraud and corruption and all sorts, and that's just one example of that, of how important this is in a market like India.
Yeah, exactly. When you look at the returns here, the share price NAV returns aren't much different, to be honest. So, but where are we with the discount at the moment?
So yeah, it's been a bit range bound. So I think currently it's just sort of moved into double digits, and it's been sort of swinging around the sort of 10% level for quite a long time now. Somewhat to our frustration, on the basis that whilst near-term performance has trailed a little bit, as you saw on the slide, the longer-term performance has been pretty good, and even through periods of good performance, it's not sort of really moved the discount, which, as I say, has been a bit frustrating. The board of the trust does obviously track this extremely closely. It does engage in periodic share buybacks to address the discount from time to time. But I think my feeling is that a lot of this is just a sort of asset class issue. So I think when you look across the peer group, the discounts have sort of stayed stubbornly wide, irrespective of sort of fundamentals and performance. And so my hope is, and it will happen eventually, Asian equities as an asset class will come back into favor. I think maybe it needs the US to actually go into recession, and US markets to tumble, but at some point you'll see that sort of that rotation, and Asia will be back in vogue, and I think we just need those flows to come through to sort of address the discount.
Yeah, exactly. Well, thanks very much. I think we covered an awful lot of ground there, and I think the other question there we've already answered. So on that note, I think we'll thank you, and just wish you all the best for the come rest of the year, I think, and then maybe get you back again next year. If that's all right.
Yeah, no, be delighted to, and thank you very much. It's been great.
Great, thank you. Let's just put this up so we can see. There we go. So we will be back next week and talking to the manager of Bearing Emerging EMEA Opportunities. And then we just said we've got a full kind of schedule for you all the way through the summer. I think all the way through to September now. So good to talk to you this week, and have a good weekend, and I will see you next Friday. Thank you. Bye-bye.